All right, welcome back. So, on today's video on how to secure yourself financially, looking at investing classroom from Morningstar, and so they offer you is several courses such as featured content, stocks, funds, portfolio, bond, ETF. I don't know what is that, and sorry, ESG, environment, social, and governance. So on the featured content, where we have 7 models: staying investment in the market, market downturns and recovery, asset class and downturns, risk and volatility data, investment strategy for a volatile market. So don't focus too much in the short term, and dealing with financial stress, which is this, right? So okay, the TLDR for staying investment in the market is because Morningstar is showing you this historical data of different asset classes, a period of consecutive negative returns, stocks, uh, crisis and long-term performance, uh, the performance of stock after the end of a recession and the history of interest rates. Okay, so the TLDR for all of that is, or the things to know, the key point of this: stock has provided the highest return and increasing the wealth over time. Investor must have discipline and patience. Also, holding on can pay off in the long run. On average, the accumulated return perceived by small stock outperform those of the large stock after 1 month, 3 months, 6 months, a year, and 3 years after the end of a recession. So when we talk about small caps or small stock, large stock, usually small cap, like this, so uh, small caps are, according to Wikipedia, are public company whose market cap or market capitalization is about 300 million to 2 billion, right? The precise figure varies, but at least between that range. That's small cap stocks between 300 millions, 2 billion. Okay, the market cap. And also look at that the Fed use the federal fund rates and try to achieve that by buying and selling government security in the open federal markets. And the reason to that is because this is one of the mechanisms that they have to set monetary policy, to regulate economy. Okay, so federal fund rate is a short-term interest rate, much like a treasury bill or one-year maturity government bond. And the the interesting thing and the revealing thing of this is, well, we actually, by looking at the federal fund rates and a little bit of the history of interest rates. So what is history? What is an interest rate? An example of that: what is loanable fund markets, which is a market where companies and corporations, governments, uh, do exchange or ask for loans. They usually do that through a financial institution. So this is pretty much like when you ask a loan for your mother or father, uh, but with some subtlety, because Unlike the governments on bond or companies that they ask for loans or any other parties, the borrowers and lenders, where they make transactions usually through a financial institute at large or at scale. When it comes to your family or neighborhood, especially your family, this is much like uh, asking loans for your parents. And but the funny thing here, and not so funny, is that you ultimately have to pay for them. You have to pay to them. You may like that or not, who knows? But it's kind of like the idea here, right? Or at least one representation from uh, from the macro to micro. So um, just to dive deep into that particular example. Uh, so imagine that your father and mother, anytime you ask for loans, they are in their benevolent presence, give you that for a 5% interest rate because they love you. And so with that, okay, you not only are able to do that, to ask the loan, but imagine that you have brothers and sisters, younger brothers and sisters, right? And you think that you're smart, and you now resell or resell your loan to your younger brothers, and you try to sell a dream to them. Like, you know what would be cool if you have a lot of candy in your hands, right? And you try to sell that dream to them, and ultimately, well, what happened is that, let's say you are able to do that. Let's say you're a great mother, a great businessman, and you do that, right? And you set that interest rate to 7%. So to prevent this, your parents or the federals, right, the U.S. Federal Reserve, uh, intervene and make operations in that market. So he knows, and because he wants to control what is the interest rate at which you're going to exchange that. So he say, hey, you know what? I'm going to offer you a for a 5%. So your parents are now offering to your younger brothers a loan to fulfill their dreams, having a candy store for 5% interest rate. So you cannot compete that. So you have to lower your interest rate. So that's a real life example, or an example that I would like to use. It's very somewhat pretty fucked up, because the idea that your parent charges you interest, uh, for some family may be wild, from other not. You can, but I really like that example. To explain what is a federal fund rate, which the Fed tried to set that target by buying and selling government security in the federal open market. And this federal fund rate is what commercial banks use to lend fund each other overnight. So that's starting to make sense, a lot of that. And so yeah, that's one key point of one of the theme of the history of interest rates. Understand the vulnerable bond markets, and then then I look at the market contraction and expansions and what happened to the bond market or the loanable fund markets. That much like the stocks, uh, This is affected by the state of the economy and by the demand and supply for loans. So during an economic contraction, the demand for loans fall, making the or causing the interest rates to drop to stimulate consumer spending, or the Fed wants to do that to stimulate consumer spending. And during an economic expansion, the demand for loans tends to rise as their interest rate. And also because it wants to control, especially the Fed wants to keep in check inflation and tighten monetary policy by increasing the interest rate, something that I'm going to look especially on bonds. So that introduction lead me is to the market downturns and recovery. And again, similar as staying investment in the market. When Morningstar showed me is this historical graphical data uh, over the past 94 years examination of capital market return, also with the downturns and or the major recessions as uh, the history of interest rate and the performance of the stock after the end of a recession. So now I'm focusing here is at looking at the contraction and expansion again by looking at the 49 years examination of that and um, mhm, 49-year examination. Um, mm, okay, I'm here. Just take a quick break. Uh, so by looking at that 49 years examination of the where there have been 10 market contractions, especially here, the market downturns and recovery, okay, see that the contractions put an end of a market cycle, meaning a complete round of a stock price fluctuation that can vary in length and time. So a contraction is defined by a period when the stock market peak fall 10% or decline from its 10% or more. And again, this is something that can happen at random times. And the expansion is the measure of the expansion measure is the recovery of an index. The recovery here is the upswing or the boom in price security following a long decline. The term is also used to describe the boom nation's activity economy. And the index is this statistical reference of investment expressed as a percentage in a period of time. So the whole idea of the index is to measure progress. So during recoveries uh, or during expansion, the recovery, uh, which measure is the recovery of an index from the very bottom of the stock of Jesus. So an expansion measure is the recovery, this boom, the upswing, price security following a long decline, or it's also measure the boom nation's activity economy. So during an expansion, it measures the recovery of an index. This is a statistical reference of investment as expressed as a percentage in a period of time. So the whole idea of an index is to measure progress from the very bottom, or from the very bottom of a contraction to its previous peak, and the subsequent performance and the subsequent performance of the index into the next level peak uh, before or until it reach a next level peak before another 10% decline. I know this is a lot of technicism as well, but this is something important because the devil is on the detail. Why this is important to you? Okay, are you going to talk to someone else about that? Might be, who knows? And yeah, so the thing is that by looking at this, okay, it's important to know this contraction and expansion, okay? And the things to know here is that investor should have a long-term investment horizon that allow their investment to grow over time, okay? And then I look at the market downturns and the recovery, which is, to me, is has been very, very helpful. And as an investor, you get a full picture, or you get a better picture of the potential market performance. So the US equity market has passed through several downturns, and the most severe of that has happened at the beginning of the Great Depression, meaning a period when the recovery lasts for 12 years. You gotta be kidding me, man. When I read that, to me, it was like, you gotta be kidding me, man. 12 years of recovery, over 12 years of recovery, and the stock market lost over 80% of their value, specifically 83.4%. Meaning that if you buy some Coke, a drink, uh, and you put that in the fridge, and the next morning you open up, you grab that, and you say, "Hey, what the? You only have one finger of the liquid. You only have is one finger of the liquid." It's like, what the fuck's going on here? Of course, that's not happen suddenly, but over time, right? So the decline or the downturn lasts for 34 months, and the recovery was over 12 years. 12 years. More recently, at the dot-com bubble in the early 2000s, the stock lost 44.7%, and the recovery period lasting for 4 years. And in the 2008, with this banking and debt crisis, uh, the recovery lasts over 3 years in the 2007-2008 banking and debt crisis. So looking at this pattern, it's like, yeah, okay, most of this downturn has shrunk considerably, but one thing is to read about historical fact, and the other is to live that. That's two different completely Pokemon, two separate completely Pokemon. Uh, so in any case, by looking at this, right, it is important to understand that from this market downturns and recovery, that stocks are prone to sudden lost value for many different reasons. Okay, for many different reasons. And again, they mention is that investors should have patience. So the recovery period may be painfully long. So investors should have patience because the recovery period may be painfully long, and often the decline is preceded by a period of high return. This decline is preceded by a period of high return, of course, which lures investors into a false sense of security because no one can predict market decline. Well, certainly, a diversified portfolio may be the best solution for the long term. Again, this is our strategy for dealing with volatile market. So one of the two main strategies that has been provide or that are the best according to Morningstar is DCA and a diversified portfolio, meaning that DCA is dollar cost averaging. It continually purchase stocks or continually make continuous purchase regardless price fluctuations. And maintain a diversified portfolio is like, well, having your investments in different companies, perhaps in different fields. The whole idea here is to minimize risk as much as possible. However, a diversified portfolio does not eliminate risk, and DCA doesn't ensure you profit, which is something that I painfully figuring out that. Okay, so DCA doesn't ensure you profit or protects against you or protect you from losses in declining markets. I actually leave that. To me, it was like holy in me, you know. But yeah, okay. Woo. So two things to learn here, right? From the market downturns and recovery. For the contraction and expansion, investor must have a long investor must have investment with a long-term horizon to allow them to grow over time. And by looking at the downturns and recovery, the TLDR, stocks are prone to loss. Stocks are prone to sudden loss in value for different reasons: geopolitical, pandemics, war, lack of productivity, outsourcing, you name it, right? And then I look at the market downturns and yeah, and then I look at the market downturns and recoveries like this. Okay, and then I look at the market downturns and recoveries. Okay, but with respect of the asset class. So with respect to asset class, such as stocks, bonds, and other class, uh, yeah, such as stocks, bonds, and other class. And here I'm repeating myself here, uh, such as stocks, bonds, and other class along another class. This another classes along with some sample portfolio structure. We will also look at the correlation of different assets with a broader market. So we begin by looking at bond yields during recession, okay, and the driven factors. So bond yields are driven by factors such as the supply and demand for loanable, or such as the demand and such as the demand or the supply and demand for loans, monetary policy, and inflation. Because the Fed use the federal fund rate and the discount rate, this rate at which commercial banks, when they ask for short-term loans, are charged. Uh, it used this as its primary tool for set monetary policy to regulate economy. Okay, and during a recession, okay, so during a recession, so during a recession, so the demand for loans fall, and the Fed's lower interest rates, or lower rates to reduce the cost of borrowing and to help stimulate consumer spending. So it does that to reduce the cost of borrowing, because after all they are the ones who print money, so to reduce the cost of borrowing and stimulate consumer spending. So during an economic expansion, the Fed want to keep inflation in check and tighten the monetary policy by increasing interest rates. So short-term interest rates, such as treasury bills, have a close correlation of the federal fund rate, which the Fed targets through open market operation. This is something important. This is something important to understand that, because this slowly gives you insight of what happened in this game called life, especially in the financial system. Because at the end of the day, the capital allows us to have more options, you like it or not, but it's like that. The stocks are like that. So, or knowing much more about finance allows you to do that, or to have more options for that. Uh, and well, here describing this. So, for example, if you want to know about what is the federal fund rate, so you can look at the treasury, and the reason to see that is because you want to know what is the rate at which commercial banks lend fund each other. So the treasury bill rate has a close correlation to the federal fund rate. So by looking at this here, well, no, I mean the treasury bill rate. That's right. And is this right? So right now is this. Okay. In March 2020, banks lend fund each other to this. Okay. So we're getting out. So we're getting out to this recession. Mm, interesting. 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 So this graph illustrates. Mm, you know what? What is the bad thing of all that? Is now this data is now public. That's one of the great things of this. This data is now public, my friend. Mm. If you remember from the banking and debt crisis during the 2007 2008, which is this. Okay, uh, here it began the bubble here, and now the lower is the interest or since uh, so the banks lend or drop their interest rate vastly. And this recovery, according to Morningstar, the recovery period lasts for over 3 years. So we're talking about 2012. Let me look at this. So I'm talking about is 2012. Look at the term of recovery here, right? 37 months in March 2012. In March 2012, in March 2012, and they keep that treasury bill with again it have a close correlation to the federal fund rate. Doesn't mean they are the federal fund rate, okay? Federal fund rates. Uh, federal fund rates. Okay. The federal fund rates. They started to increase that. The federal fund rate has a close correlation with the treasury bill. The federal fund effective rate. You know that begin to rise. Oh my father, yeah. And during this period where the interest rate went at its highest, Jesus fucking Christ. Holy fuck. They leveraged the economy based on debt. You gotta be fucking kidding me, man. You gotta be fucking kidding me, man. You gotta be fucking kidding me, man. Completely. You gotta be fucking kidding me, man. Totally, man. You gotta be fucking kidding me, man. So, because exactly during the Yom Kippur War in 1973, the Petromonarchy performed a since the Arab states, according to Wikipedia, Arab states attacked Israel forces and U.S. backed Israel. So the OPEC or the Arab states cut the oil and they create this massive bubble here. And they create this massive bubble. That's one of the reasons is that, man, do you really think that the United States like is trying to impose them? You know, it's trying to impose. It's trying to have this dominant role in the world. Any empire have done that in the past. So right now we have this, or I'm looking at this historical data, uh, and see how powerful it is to make decisions, to inform, to persuade myself or others, but also can be misleading as well. Depending how do you use this data. Hmm. Interesting. Interesting. Mm, Land fund. Oh my god. It's like interesting. Looking at this historical data, so right now, exactly. So the interest rate right now is 4.5%, and the federal fund rate is 4.10. 4.10, and Treasury bill has a close correlation. Treasury bill rate is a close correlation. It's a close correlation to that, to this short-term interest rate. Oh my god. Oh my god. It's like, oh my god. Oh my god. Oh my god. Okay. Oh my god. So it's like, oh my god. Okay. So keep looking at the asset classes and then term. That's right. Um. So yeah. So bond yield to a recession. And again, looking at this is just to help me a little bit more knowledgeable, a connoisseur of this, uh, and then take better, well-informed decision. Right. Basically, that's like, this shit is freaking fucked up interesting. Yeah, yeah. This shit is pretty fucked up interesting. It's like, holy fuck, dude. Yeah, holy fudge. Holy fudge, nigga. So, okay, so bond yields are driven by factors such as the supply and demand for loans, monetary policy, and inflation. So, because the Fed has the discount rate, the rate at which commercial banks are charged for short-term loans, and the treasury or the federal fund rate, which is the rate at which commercial banks lend fund each other. So during an economic expansion or during economic contractions, the demand for loans fall, making the Fed lower interest rates to reduce the cost of borrowing and stimulate consumer spending. And during an economic expansion, the Fed wants to keep in check inflation. Okay, so the Fed may want to keep inflation. So the Fed may want to keep inflation in check and tighten the monetary policy by increasing the federal, by increasing the interest rates. So the Fed may want to keep inflation. hmm So the Fed may want to keep inflation in check. That's right. So the Fed may want to keep inflation in check. So the Fed may want to keep inflation in check and tighten monetary policy by increasing the interest rate. So short-term interest rates such as Treasury bill has a close correlation of the Fed with the federal fund rates, which the Fed targets through open market operation. So short-term rates have been more volatile, whereas long-term rates, which have a maturity of 20 to 30 years, has been relatively stable and have taken longer to react. So right now, again, looking at how bonds rate are affected by inflation in bonds can be thought as an IOU between the lender and the borrower with details about the loan and its payment. So specifically, loans from Investopedia or bonds from Investopedia, they are unit of debt issued by companies or government that can be converted into tradable assets. So an issue is debt, and then you can convert that debt into some tradable asset, a land, a property, whatever you want that. Oh my god. Oh my god. It's like, what the flying fuck am I learning here? So my entire life is a lie? So my entire life is a lie. Ah. So yeah. Yeah, your entire life is a lie. So yeah. So my entire life is a lie. In any case, uh, but so how bond rates are affected by inflation. Specifically, long-term bond yields are sensitive by inflation expectations because it can erode the value of that. It's just inflation expectations. Okay, so if inflation expectations are high, lenders, meaning uh, if inflation expectations are high, lenders require a higher interest rate to lend funds. So, for example, if a company is issue a bond, lenders, which are those who buy bonds, lenders, mhm. So lenders, well, I'm a little bit tired here. uh, yeah, I'm a little bit tired here after reading all of this. This is, I'm not gonna lie, man. I'm not gonna lie. Um I'm not gonna lie, by the way. So, in any case, I'm going to read about this, but after that, I'm going to wrap up this. So, bond yields, especially long-term bond yields, are sensitive to inflation expectations because because inflations can erode their value. Okay, and if inflation expectations are high, lenders require a higher interest rate to lend funds for more than the short term. Therefore, if inflation expectations remain high, long-term interest rates may take longer to drop even during periods when the Fed is cutting rates in the long run. Interest rates, in the long run, interest rates could even rise instead of fall. Things to know. This has been a general decline of rates since the recession in 1982. Again, we're talking about bond yield during recession. Okay, bond yield during recession, stock after the end of a recession. Okay, so although uh, interest rate has generally dropped during recession and rising during expansion, there have been a general decline of rates since the recession in 1982. Prior to that, interest rates were driven up because of the oil price shock of the 1970s, as the Fed aggressively pursued a strategy to lower inflation. Interest rates began to fall and actually reach unusual low levels recently. So as the Fed aggressively pursues a strategy to lower inflation, interest rate begins to fall and actually reach unusual low levels recently. Because back then there was this oil price shock they called the nation is the Yom Kippur War. Keep in mind that bond yields and price move in opposite directions. When yields for new bonds fall, existing bonds with higher yields become more valuable and can demand a higher price. Conversely, when yields for new bonds rise, this is something that, and again, I'm just going to wrap up here and wish you the best. Take care. Bye bye.